the $100 billion IPO. It's the DIDI Analysis. I'm your host, David Scheuer, and this is StockerFinance. Twitter.com/StockerFinance for more information. The newsletter link will be below. So what is DiDi? Well, here's the summary of this company. It's essentially the Chinese Uber, which is a driver-for-hire company. It was founded by Cheng Wei, sorry if I'm mispronouncing his name, by the way, in 2012. He was a former Alibaba employee and is currently worth around $3 billion US, and he currently owns 7% of DiDi shares with 15.4% of the voting power, but that is pre-IPO. In November of 2012, Tencent invested $15 million into DiDi. Tencent currently owns around 6.8% of the company, with SoftBank Corporation owning 21.5% of the company. DiDi definitely has some very powerful backers, especially in the Chinese market. That currently dominates the Chinese ride-sharing market. It had some rivals try to pop up here and there, and currently does have a few rivals in the Chinese market, but they really aren't making a dent compared to what DiDi is currently operating. It currently operates in 14 other countries as well, and is continuing to wanting to expand into Europe and into the United States as it is right now. It just recently expanded into South Africa, Cape Town specifically, as well. The Chinese drive-share market is estimated to be worth nearly $100 billion by 2023, which is up from around $53 billion in 2019. It's experienced some immense growth over the past few years. Logistics, personal drivers, bike rentals, and more, DiDi really does it all. Essentially, you could compare this company to Amazon more than you could Uber, and we'll get into that more later on in the video. DiDi is also currently working on autonomous driving technologies. Now let's go ahead and compare DiDi versus Uber. You could say it's arch rival, especially as Uber was competing against DiDi in the Chinese market. Now, Uber was actually pushed out of the Chinese market by DiDi, which really shows just how competitive DiDi is compared to other rideshare companies. Uber China ended up selling off its business to DiDi and became a minority investor. And this is really where it gets interesting. DiDi invested $1 billion in Uber as a part of the deal, but Uber China agreed to sell its operations to DiDi in 2016 in exchange for a minority stake in the company. Now, that minority stake actually is worth Uber owning around 15.4% stake in DiDi. Now, that stake was diluted from around 18% in 2016 to the current 2020 stake of around 15%. So even though Uber is a direct competitor of DiDi, and DiDi is now trying to IPO in the US market, if DiDi has a very successful IPO, which it most likely will, since it's a very anticipated company coming into the United States market here, if it raises tons of money, that's going to directly benefit its competitor, Uber. These companies are very tied together, but also direct competitors. It's really interesting. If we make some other comparisons here, DiDi has significantly more users than Uber does, at 156 million. Monthly active platform consumers for Uber are at around 98 million. Less than half of the revenue that Uber does, however, but it also takes a bigger cut per ride, so it's more profitable per ride than that of Uber. Now let's dive into the fundamentals of this company. And here's a quick summary, since reading a lot of these statements in the S1 or F1 document can be very difficult and challenging for some individuals. $26.6 billion in revenue last year. It was actually quote-unquote profitable last year on $6.4 billion in revenue, and it did $837 million in net income before payouts to shareholders, with a comprehensive net income of $95 million last quarter. Now, between 2019 and 2020, DiDi's revenue actually shrunk around 10% as the COVID pandemic struck China very hard last year. Compared to the US, however, China did have a pretty rapid recovery and recovered, or opened at least, I don't want to say fully recovered, but opened at least before the United States started to open, which definitely helped DiDi in its rebound. Revenue grew 11% between 2018 and 2019. Additionally, revenue completely bounced back in the first quarter as the pandemic recovery is in full swing, with 107% growth in Q1 from the previous quarter last year. Some of the company's profitability in quarter one can actually be credited to gains on investments of $1.9 billion related to spinoffs and divestments. So although the company was quote-unquote profitable, most of that profitability really just came from gains on its investments. By the way of comparison, Uber reported a net loss of $108 million on revenues of $2.9 billion in its first quarter. For all of 2020, Uber's net losses amounted to $6.77 billion on $11.14 billion in revenue. To continue with the fundamentals summary here, I'm going to go ahead and dive in to the F1 registration statement. Now, keep in mind, this company is filed as an ADS, which is completely different than if a domestic company were to file here, and that definitely comes with some risks, which I'll touch on later in the video. Now, it currently operates in 15 countries. I said 14 other countries earlier on, so this is counting. This is counting China, by the way. 493 million annual active users, 15 million annual active drivers, 41 million average daily transactions, 341 billion, and that is in the Chinese currency, by the way, not in US dollars, with $600 billion plus, or not billion, I keep saying dollars, that's in the Chinese currency as well. I will go ahead and try to convert that in other parts of this video here. Now, what I really found funny about this document is the story, and they start out by saying, we realize that our business is fundamentally different from other platforms. Well, not really. I mean, to be honest, they pretty much copy and pasted the entire Uber platform in China, as well as many other apps and platforms that United States companies have innovated and created. So a lot of it's just copying and pasting, as a lot of Chinese companies do. Now, I'm not saying, that is controversial. I'm not saying there's necessarily something completely wrong with that, since they are operating in an entire different market. But it is kind of funny how they create the story saying that they made this completely unique company, and they thought of this idea by standing at a bus stop and they couldn't get a ride when it was really cold. And so he thought of randomly that they should start a rideshare company. If they were honest about it, they would say, hey, we saw Uber doing really well. We don't want them to, do as well here. So we're going to go ahead and start our own company, make tons of money, and compete directly with Uber, and then try to enter into the United States market to completely out Uber, even though Uber is also a partial owner in their company, which makes this whole situation very unique. Now let's go ahead and just hop into the consolidated statements of comprehensive income here. You can see the revenue we've already really touched on there. 3 month ended March 31st as of 2021. They did $5.988 billion in international, or in what is that, in the China mobility? I'm reading that right? Yes, that is the China mobility revenue. International revenue of $123 million, and other initiatives, which we'll touch on in a bit here, $324 million. The other initiatives section is where this company really gets interesting, and where it really starts to look more like an Amazon or just a huge conglomerate versus that of just a rideshare company. You can also see the positive net income here as of last quarter of $837 million. If we go ahead and look at the consolidated balance sheet, we see cash and cash equivalents of $3.582 billion, with restricted cash of $80 million, short-term investments of short-term investments of am I reading that right there? Yeah, $3.658 billion. If we look at the total liabilities here compared to total assets, you can tell that total assets significantly outweigh total liabilities, $24 billion compared to liabilities of $4 billion. They are at a deficit for the shareholders' equity of $10.6 billion, however. That is kind of alarming for this company, but again, we're dealing with a rideshare company. Do we really expect them to be in that, in such a prime financial state? In my honest opinion, no. These companies are almost never in a prime financial state, and you really have to take that into consideration when considering an investment in this company. If we look at the consolidated statement of cash flows data here, we see net cash used by operating activity, a loss of $937 million. They used around $307 million in investing activities, but net cash provided by financing activities as of last quarter was $1.569 billion. On top of that, they increased their cash equivalents, and restricted cash by around $360 million last quarter. On top of that, the cash equivalents, and restricted cash at the beginning of the period was $3.3 billion. That increased by the end of the period to $3.662 billion US dollars. Now let's talk about something that gets really interesting here, which is DiDi's technology, and significantly more than that as well. First off, let's look at what I was talking about, kind of their other sources of revenue, and one of those is their auto solutions. So first off, they lease vehicles. They have over 600,000 vehicles in their leasing network, and drivers can browse vehicles available for lease, sign a lease, and pay online through their platform. On top of that, they have refueling stations. In fact, they have a huge nationwide network of over 8,000 refueling stations, including 200 liquefied natural gas stations as of March 31st, 2021. They're essentially a partial natural gas and, gas station company, which is just absolutely crazy. They're also an auto leasing company. They also do maintenance and repair services as well. They're really capitalizing on every single part of the rideshare service, not just the ride itself. They're capitalizing on the car that the driver is riding on. They're capitalizing on the fuel that's going into that vehicle. They're capitalizing on the maintenance required for that vehicle and more as well. We also have electric vehicles here. They have the largest electric vehicle charging network in China in terms of charging volume in the first quarter of 2021. Drivers have access to almost 88,000 charging devices nationwide, over 30,000 operated by us or by them, and almost 48,000 operated by their national and local partners, with over 1,392 megawatt hours of energy they charged on their platform in 2020, which is an increase of 105% from that of 2019, which really shows China's effort in increasing the amount of electric vehicles on the road. Other initiatives, as I touched on slightly here, bike and e-bike sharing. Bike and e-bike sharing provides consumers with convenient and affordable alternatives for short distance transport as well. If we go ahead and look at this, sorry about the low quality of this image here. Again, they have around 10 million monthly active users with this city right here, by the way, and this is a day in the life of consumers and drivers in Chengdu. Definitely pronounced that wrong. I apologize. So in this city here, ride hailing, they have a 1 million average daily transaction, 41,000 average daily transactions for taxi hailing. Chauffeurs, they do offer a chauffeur. If you're out at the bars, you can get a chauffeur for that. 49,000 average daily transactions. Hitch, I wasn't exactly sure what that was. I didn't see too much of a description for it. Let me know if you find that out. 10,000 average daily transactions, so a much smaller portion of their business. Enterprise, 20,000 average daily transactions. Bike and e-bike sharing, 1 million average daily transactions. Refueling and charging, 23,000 average daily transactions. Intra-city freight, 14,000 average daily transactions. Yes, this company also does freight. They deliver products for you, and they do logistics as well. Community group buying, 269,000 average daily transactions. This company really does it all. It's absolutely incredible. Keep in mind, these statistics were just for that city. Here's all the different apps that they offer. This ranges from freight, from chauffeur drivers for specific drivers. They have a finance as well. They provide financial services, including loans and insurance. They also, again, have the e-bike services, group buying. They do also in Brazil. They provide mobility and other essential services. They do so many different things. Piggy Express, that provides ride-hailing service just to younger customers. So I'm guessing for little kids, maybe needing to get to school and such. DiDi Express, Enterprise is for their business clients. I mean, they really do it all. I mean, every single portion of a ride, hailing service that you could capitalize on, they've capitalized on, which is absolutely pretty crazy. Now let's move on to some economic factors here. And one thing that I want to point out here is the attractive opportunities within the ride-sharing market. Now, an estimated ride-sharing market is growing at a CAGR of 16.6%, currently worth $85.8 billion US dollars, but estimated to reach $185.1 billion by 2026, and it definitely could be more than that as well. Now, let's go ahead and look at the estimated worldwide automobile production from 2000 to 2020 here. You can see that since around 2018, we've seen a drag in worldwide automobile production. However, I do expect that to pick back up again. You can see that in 2007 to 2009, during the financial crisis, we saw a drag on it. Then during COVID, that definitely didn't help. I wouldn't be surprised if we start to see an uptick in automobile production as well, especially with the rise of electric vehicles. Companies are currently transitioning to that, and I think that's taking a lot of the automobile production away, since a lot of their capital is going towards research and development right now. We do have Tesla really leading the charge, though, with electric vehicles, especially here in the United States, and been operating in the Chinese market as well, where it's been wildly successful and will probably continue to be. We also have the Chinese population. An important factor here is the population gets bigger. Simply means more families, more people need more rides. We also see that in India and the United States as well. The United States has really flatlined its population, not growing nearly as fast as China's, but China's has started to level off as well at $1.398 billion as of not dollars, the population, 1.398 billion people as of 2019, most likely bigger than that. Once they do the consensus and once they do the census, get a whole, much more data, we'll find out what the 2021 population, or at least what the 2020 population is as well. It'll be interesting to see if that growth has leveled off or if it has continued to rise, especially throughout COVID. Now let's talk about some investment risks. We've really talked about a lot of the positives, a lot of just the craziness of how many different segments this company operates. We've also dived into the fundamentals of this company and looked at its fairly healthy financial situation, but of course, it's, at a shareholder's deficit. I wouldn't expect anything else for a rideshare company. Now, investment risks here. Probably the most prominent risk is just simply the Chinese government and the legal system. Especially U.S. investors have to understand the risk with investing in Chinese companies due to the severity and just how harsh the Chinese government can be on these companies. We saw that with the Ant Group intervention and the whole thing with Alibaba's CEO Jack Ma essentially going missing for a while. We've seen that happen with multiple powerful people within China. Although they didn't kill Jack Ma or anything like that, he's still alive and doing well, it appears. They definitely sent a message, and that did some serious damage to Alibaba's stock, which was a major holder in Ant Group. And while it was about to go public, which would have been an immensely profitable opportunity for Alibaba and its shareholders, they ended up blocking the entire thing simply based off some comments which were direct criticism of the Chinese government from Alibaba's CEO, Jack Ma, and that was kind of their punishment for him. If we go ahead and look at the F1 form here, government, the word government, and most of it is all directly related to regulations and guidance in regard to the Chinese government. It was mentioned 140 times in this document. That's definitely alarming, and you can really tell this is one of their very large worries, and they're really trying to warn shareholders of this worry, although they definitely want you to invest in their IPO as well. Now, Tencent, DiDi, and other internet firms a while ago were also slapped with a fine by antitrust authorities for failing to disclose deals. We also saw them on the list of potential Chinese companies to be completely banned in the United States. We also have senators here, Marco Rubio. He's saying the SEC and is making an argument that should block the entire IPO of the Chinese ride-hail company DiDi. So there is a lot of backlash for this company. It's going to be a lot of criticism, and it's going to be really interesting to see where this company goes. I do expect this IPO to be at least around a $100 billion IPO. Whether I'm willing to invest in this company, I'm going to save my opinion for Twitter and maybe some other videos. Let me know what you think, and I hope this video served as a great summary of this company and a great analysis of this company as well. Whether I'm bullish or bearish on this company going into the future, I think this company has a lot of potential, but again, there's significant risks that come with it. I'm fairly neutral with this company. I think it's going to have a very successful IPO. After that, I really don't know what's going to happen. It's really going to be up to the U.S. government, the Chinese government, as well as some other macroeconomic factors. Do I think it will be successful in the U.S.? If it can offer the right prices and be profitable at the same time, it'll be wildly successful. I think the fact that it's a much more diversified company than that of Uber or Lyft especially gives it a huge advantage. The fact that you can order groceries on the app, the fact that you can get loans and financing and do so many different things, maintenance, you can get bicycles, you can have chauffeurs, which I think is really cool. There's so many different segments to this company that make it significantly more diversified and a much more powerful company than that of Uber or Lyft. But again, you also have a very interesting situation with Uber actually being a shareholder, a major shareholder, especially around 15% ownership in DiDi, which gives this a really awkward situation. No matter what, when this company goes public, it'll definitely benefit Uber, and shareholders of Uber should definitely watch out for that going into the future. Anyways, keep an eye on this company. Let me know what you think in the comment below. Please comment. I love reading comments. Follow me on Twitter as well, twitter.com/StockerFinance, and thanks for watching. Please subscribe. Check out these videos as well. Make sure to subscribe again, and the newsletter link will be below. It's a once per month newsletter. I do some investment education, analysis, etc. It's only once per month. Not going to spam you, not trying to sell you anything. I just like doing it, to be honest. So subscribe to that if you want. It only takes your email and your name or something like that. Not a big deal. I'll see you guys.